Welcome to Module 3, Section 2, where I will discuss the topic of using margin. When we talk about the concept of margin, basically this allows for leverage. You have a certain amount of money, and margin allows you to, in essence, double the ability of that money to buy something. Leverage is the ability to control an asset without having all of the required funds available. And if you think about this, it makes sense. When you buy a house, let's say your house costs $100,000. I know that's not realistic, but just as an example, do you have to come up with that $100,000? No, you might have to come up with 10% of it, or maybe you have 20%. You probably don't have the full purchase price of that house, so you have to go and borrow the rest. Well, even though you borrow that money, you still have use or control of that asset. You may not have even made any mortgage payments yet, but you will say, I bought a house. And you will treat it like it's your very own, and you will call it your property. So there's a real ownership there. Well, leverage can also be used in the stock market. You can deposit an amount of money and then borrow additional money to be able to purchase more stock. Other examples of margin could be credit. This can be installment loans, where you buy a car and then you pay that off over a period of time. Mortgages, which is what I referred to just a moment ago. These are all different forms of leverage. An asset is allowed to be controlled with an amount of capital that's much less than the value of the asset itself. When we're talking about the stock market, there are some requirements that we have to be aware of. How long the investment is held, whether you're going long or short. And if you don't understand what long or short is, please refer to the link to my other video that talks about this. Whether you hold on to this for a few days, few weeks, few months, or few years, the requirements are going to vary a little bit. And how margin is calculated will also vary. Please understand that I'm referring to margin in the stock market. If you trade the Forex market, if you trade futures contracts, the margin is different. I'm just trying to use it as it applies to buying stocks. By default, many brokerages will establish a margin account when you open that account. Some people don't even realize this. They go to a broker, let's say TD Ameritrade or E-Trade or Scottrade or Charles Schwab. They open up an account and they see all this legal stuff that they have to read through that you go through very quickly just so you can sign or click saying that you read and understand this. You may have just opened up a margin account. Now, that's fine if you want to use margin. But that's not fine if you think that using margin is not best for you. You may have an account right now or multiple accounts. Do you know if they're margin accounts or not? You probably want to go in and check that. The idea behind this statement is not to say they're good or bad. You just want to be sure that you know what you have. Margin allows funds or stocks to be used as collateral to borrow additional funds. If you put $5,000 into an account, you basically can borrow against that $5,000, which increases the amount of stocks that you can buy. Since 1974 in the US, the margin rate that is set by law is 50%. Just as an example, if you open an account for $5,000 and it's a margin account, you have the ability to buy $10,000 worth of stock. If you buy $1,000 worth of stock, you only have to come up with $500. The additional $500 would then be borrowed from your broker. This also allows for 2-to-1 leverage. $10,000 account, you have $20,000 of buying power, and that would be a fully margined account. One of the nice things about a margin account is that the interest rates are typically low since the loan is fully collateralized. It's not like you're walking into a bank and saying, yeah, can I borrow $10,000? Well, what do you have as collateral? Well, I'm a real nice guy and I always pay things on time and I promise I'll pay it back. That's just a promise. Where in your brokerage account, you have actual funds in your account that you're using to buy actual stocks that have value and that is fully collateralized. Your broker is taking less risk. Since they are taking less risk, they can charge lower interest rates. A stock must have a price above $5 a share. If you're looking at a $2 or $3 stock, you're not going to be able to buy that on margin. Another thing to be aware of is if you buy a $10 stock and it drops to $4 and you bought that on margin, that stock could lose its ability to be margined. And then you have to come up with the rest that you borrowed if you want to maintain that position. So then it's a good idea. If you want to use margin, don't even consider stocks that are under $5 per share. What I did is I went out to Charles Schwab's website, and I don't even have an account with them. I'm just using them as an example. As of October 2021, these are the current rates, because when you borrow money, you have to pay interest. And what they have is a base rate. And the last time this base rate was set was in March of 2020, and it stayed the same. Now, this can change at any time, but at Charles Schwab, what they do is the bigger your account, the lower your interest rate. I will guess that since most of you watching this are beginning in the stock market, you'll probably fall in the $0 to $24,999.99 category. So you would pay the base rate, which is 6.5% as I record this, and then an additional 1.825% to make that an effective rate of 8.325%. This is another reason why you want to pay attention to what the Fed is doing. They're the ones that raise or lower short-term interest rates, especially when they raise them. Within minutes, the base rate is going to change. Companies might be a little bit slower to have the interest rate go lower because they're making profit on that. So how do we calculate the interest? If $10,000 is borrowed for 1 year and you fit into that first category, the interest would then be $382.50. That's for 1 year. That's the annual interest rate. And what they do is you don't get a bill for this. They just take that out of your account. They actually go in and grab it. It's usually calculated daily. And so what they do in finance quite a bit is instead of dividing by 365, they divide by 360. And instead of saying some months have 30, 31 days, February has 28, 29 days, they just say each month is 30 days. So 30 times 12 is 360. That helps to keep the math a lot more simple. If you had an annual charge of $382.50 for the interest rate, you would just divide that by 360, and you're paying $1.625 each day. So if you hold on to that for 5 days, you would just take the $1.06 and multiply that by 5, and that's how much interest you would pay for that period of time. Please note that the use of a 360-day year results in a higher effective rate of interest than if you had used 365 days in the calculation. So your interest rate is going to be a little bit more. If held for 30 days, the interest that you would pay would be $31.88. They'll probably round that up. And as I stated just before, each month is considered to be 30 days. So what are some of the uses of margin? Why would anybody even want to do this? Besides the obvious reasons, margin is typically used to buy additional shares of stock. However, margin can be used for other reasons. If obtaining a personal bank loan is not desirable or even a viable alternative, you can make yourself a loan using your brokerage account. That might be something that you would consider, and you have more control over that. You're not necessarily walking into a bank and having them say yes or no. You can say, well, I've got this margin account and I've been seeing some really good returns in the market and I have a lot of equity in that. There's this project I want to do, or there's this emergency that came up in my life and I need some money. Well, I'll just borrow against my brokerage account, and you have more control over that, which can be a good thing and it can also be a bad thing. When people get to the point of using this like a debit machine, then it can become pretty dangerous. So why would you even want to use margin? Of course, you have a lower interest. If you walk into a bank to get a personal loan, you're going to pay a much, much, much higher interest rate than the margin interest rates that I went through just a moment ago. Also, you have more control. You can say, yes, I need to do this. This is when this will happen. I'm making the decisions here instead of someone else making the decision for me. Also, a repayment convenience. When you take out a loan at a bank, you have to start paying that back, whatever payment structure is set up. With a margin account, as long as everything stays good, you can pay that back when you want to because you are in more control. But with control also comes responsibility. So if you borrow against a margin account to go to Las Vegas and you lose all that money, that's not very responsible. And now you could be in a lot of trouble. And the margin interest that you pay until the IRS goes in and changes this law is usually tax deductible. But don't quote me on that. These things are changing all the time. This is one of the last few remaining deductions that we have. And since a lot of Wall Street has a real voice in what happens in Washington, D.C., and they do a lot of things on margin, they've been able to keep it so that interest that you pay is deductible, but that could always change. If you go to a bank and you take out a personal loan that you have to pay back on a set schedule, is that interest that you pay deductible? No, it's not. But with a margin loan, that might be tax deductible. And the only reason I say might is because things do change. When buying stocks in a margin account, any excess above your cash value, so if you put in $10,000 into your account, if you buy $12,000 worth of stock, now you're in excess of the amount that you deposited, and you use that for purchases, it will be borrowed automatically, which is kind of cool. This happens and we don't have to hit any buttons or make any phone calls to make it happen. That can also be a drawback because it's more seamless. And these things are happening sometimes without us actually realizing that they're happening. And you can borrow up to your available limit. So if you have a $10,000 account, and it's a margin account, you have up to $20,000 of buying power, and you go in and you borrow $3,000 for additional stock purchases, you still have $7,000 available to you. When it is not desired to use margin, don't exceed the value you deposited. If you don't want to use margin and it is a margin account, because they come and use your money first. At least that's been my experience. But if you don't want to use margin, don't buy more than $10,000 worth of stock. So with margin, it can be a two-edged or double-edged sword. Margin can be wonderful if you're right. And this is why we use margin. It can enhance our returns because we're doubling our purchasing power. Margin can be detrimental if you're wrong and you have losses. In fact, this is one of the catalysts behind a market crash. If a lot of people get into a stock and it's going up and up and up, and they're buying it on margin and there's a lot of leverage going on, if prices turn, now you've got people who have to get out. They don't have a choice. They're running out of the equity value in their account. And so they have to sell. And that pushes prices even further down. And then it just kind of cascades and it has a compounding effect. I addressed this in another video, but a lot of people blame markets going down on short sellers when really that's not what's happening. It's people who are long that have to get out of leveraged positions. It creates this kind of crazy panic, unsettling atmosphere where all of a sudden prices are just crashing. Regardless of how an investment performs, all borrowed money must be repaid. It's really easy to say, okay, well, I bought a $10 stock on margin, so I put $10,000 into my account. I borrowed $10,000 from my broker. The price falls to $5 a share. Okay, well, I sell it, and now my broker's only going to get $5,000 back instead of $10,000. No, it doesn't work that way. Whatever you borrowed, that full amount plus interest has to be repaid. You're not in a 50-50 partnership here. And your broker has to do this, or they would go out of business really quick. When you buy on margin, they make money from the interest that you pay. But when things go against you, it's their best interest that they have in mind. You kind of come last when things are really going against you. Once you get into a position and you're using borrowed money, then you have a thing called maintenance margin. Your value has to maintain a certain level, or you're going to get what's called a margin call. So there are two types of margin. There's the initial margin, and that's usually at 50%, half, or 2-to-1 leverage. And then after you get into a position, there's maintenance margin. And by law, it's set at 25%. But your broker may have additional policies in place that can go all the way up to maybe 40% or maybe even higher. If it's a really crazy stock and your broker thinks you're really taking a risk by buying this stock, they may bump up your maintenance requirements. Once a stock has been purchased, the account must maintain a certain value level. If this level is exceeded, so you're losing money and you've used up value in your account, this will produce what is known as a margin call. They're going to call you and say, your account is not in good standing right now. We need you to do something. So how do you fix this problem? Well, you can sell the stocks that are giving you all the problem. So you can just liquidate this. And if you don't respond to a margin call, selling stocks is what's going to happen. And if it's going down and it's the reason why you're losing money, now you've locked in a loss. And maybe you didn't make that decision yourself. Well, your broker will make the decision for you. The form that you fill out said that they have the ability to do that. or you will immediately have to deposit more money to bring your account into good standing. Now, if this is a stock that's really going down in value and you really believe in it and you think it will possibly come back, then depositing more money at least gives you more control. It lets you live another day in this position. So be aware of these different choices that you have to make, and you want to define these things before you even get into this stock. What am I going to do if things go right? What am I going to do if things go wrong? Define this before you even enter into a position. As a rule of thumb, in a fully margined account, so you put in $10,000 and then you went out and bought $20,000 worth of stock, a percentage loss will double. If the stock goes down 10%, your loss is going to be 20%. If it goes down 30%, your loss will be 60%. That's in a fully margined account. And if you want to avoid that, don't borrow as much. So a 5% decline will result in a 10% loss. And these things can get out of hand really quick. And when it's happening, since most people are long, you have thousands, if not millions of other investors who are also reacting to this, and they're panicking and they're trying to get in and figure out what they're going to do about this. And a lot of times that means selling the stock. And that's where you have these out of control crashes that occur. So how do we calculate maintenance margin? Brokerage firms can vary in the percentage required in a margin account. By law, it was set up as 25%. Some brokerage outfits will say 30%. Some may say 40%, 50%. They can make it whatever they want. But the law says it has to be at least 25%. So this can be anywhere, I've seen anywhere from 25% up to 40%. And then I have a spreadsheet just to show you how this can work. And it's a very simple spreadsheet. I wanted to make this explanation as simple as possible just to understand the concept, because you can start playing around with a lot of different numbers and then you get involved in all these calculations and you're just like a deer in the headlights. On my screen right now, you see a very simple spreadsheet that I found from breakingdownfinance.com. I didn't create this. They make it freely available on the internet. And if you want to check this out, I was able to download it for free. I'll put a link to this in the description below the video, or you can just Google this to try to find out this information, because you can get really crazy with this if you want to. Using this spreadsheet, let's say the purchase price is $10 per share, and we calculate the initial margin at 50%, which is very common. And then let's say the maintenance margin is 30%. Now the loss is 25%. But let's say your broker wants you to have a 30% maintenance. What that means is the stock that you bought at $10 per share, as long as it stays above $7.14, you will not receive a margin call. If it drops below that, that's when you're going to start running into trouble. Just as another example, let's say that the margin requirement is 25% instead of 30%. You won't run into trouble until your stock drops below $6.67 per share. And you can go in with the spreadsheet and fiddle around with the numbers, change the purchase price. You probably won't change the initial margin because that's pretty standard, but you might need to change the maintenance margin. Let's say you have a pretty high risky stock and your maintenance is at 40%. You bought it at 10. As long as you stay above $8.33, you'll be okay. If you drop below that, then you're going to run into trouble. And this is a good thing just to calculate out. First of all, decide, am I going to use margin? And then if you say yes, bring up a spreadsheet like this and say, okay, this is where we're going to run into trouble. Now, things will change over a period of time. If things go in your favor, the maintenance amount will actually go up as the value goes up. But this is a good place to start to give you a good place to know where you're going to run into trouble. Another feature that we have in our brokerage accounts is, since it's all computerized, it figures this out for us automatically. But this is a tool that you can use even before you get into a particular stock position. So let's talk about risk. There are some really good points to margin and there are some bad points to margin. Each investor must determine if using margin is appropriate for them. You have to decide. Some of you may need to even start a little bit before that and look at some of your current accounts and go, do I even have a margin account right now? You may not know that. Then, do you want to use borrowed money to do this? The advantages and disadvantages must be weighed. There are good points to this. There are bad points to this. It's also necessary to control fear and greed when deciding what to do. If you're using borrowed money and things are going your way, that's fine. But if things start going against you, you're now acting out of emotion. And if you're acting out of emotion, you're going to be wrong way more times than you're right. And you have to make decisions based on the fact that you're using borrowed money, not on the fact that you think this is a good investment. So this opens the door for a lot more emotions that can really harm us to come into play. And instead of investing, instead of being mature about what we're doing, now we're gambling because we're using our emotions to tell us what to do. Margin only applies to brokerage accounts. Now, there are some differences here. If you're using a mutual fund and you only work with a mutual fund company and that's all they don't do stocks or bonds or options or futures, it's only a mutual fund company, you won't be using margin. But if you do have a combined account, maybe not for the mutual funds, but there may be margin attached to that actual account. So one thing just to remember is when you're using mutual funds, margin doesn't come into play. It's for the other things that you might be doing in your account. Is a margin account even needed? There may be instances when an investor does not wish to use margin to purchase stocks. And some of you may go, man, I like the idea of margin when I'm right, but I'm more concerned about how things are going to go if I'm wrong. No, I don't want to use margin. Or you may have a combination of the two. You might have some purchases that are based on margin, and you might even have a separate account where that's cash only. And you can mix and match these things. However, a margin account may be required if more advanced strategies are to be implemented. And I teach some of these strategies in my program. For example, this can include buying or selling options. Now, even though we don't use margin to buy or sell options, we have to come up with the cash or we receive the cash when we sell them. They quite often will have to be inside of a margin account. So you may not even buy any stocks on margin, but you still have a margin account because you trade options. It may be desired to set up an account that does not purchase investments using margin, but still allows for advanced strategies to be implemented. It's best to understand your account. I went out and I found just a blanket agreement and some disclosures. These are things that your broker needs to tell you by law. If a customer trades stocks in a margin account, the customer needs to carefully review the margin agreement that's provided by the firm. And it's small, and it's lengthy, and it's not exciting. But it's still a good idea to go over these. You can usually find them as PDFs on the company's website and take some time and go through this. A firm charges interest for the money that it lends, that I talked about earlier, to purchase securities on margin, and a customer needs to understand that additional charges may be incurred by opening a margin account. You're going to borrow $10,000, but you're going to have interest on top of that. Under federal security laws, a firm that loans money to a customer to finance securities or stocks is required to provide to you, the customer, a written disclosure of the terms of the loan, such as the rate of interest and the method for computing interest. Now, if you've read through some of these, they leave themselves a lot of outs in the things that you will read. Like, this can change at any time. If we can't get a hold of you and you need to sell some stock, we may sell it on your behalf. If you really get into trouble, we could take away your car. We could put liens on your property. It could really create a mess because they're a business and they have to protect themselves or they wouldn't be in business for very long. The firm must also provide you, the customer, with periodic disclosures informing of any transactions that took place in the account and the interest that is charged. You usually get this in a monthly statement and then annual statements, or you can go log into your account and just look. One organization that you probably want to be aware of is a thing called FINRA.org. And I took this directly from FINRA.org's website. FINRA is dedicated to investor protection and market integrity through effective and efficient regulation of the securities industry. This is not part of the government. This is an organization that's set up that if you're screwed over, you have some recourse. Now, if you buy a stock at 10 and it goes to 8 and you want to, I lost money, that's not what's covered. That's market risk. They don't cover that. But if you have some swindler broker, or if you're charged an exorbitant amount of interest and you thought you were paying less and the agreement said it was less and they end up charging you a lot more, now you have somebody to go to try to rectify any problems. And please be aware that FINRA is not a government agency. It's a nonprofit organization. So we're independent, not for profit, and authorized by Congress to protect America's investors. And this is an American thing. This is in the US. So if you're European or Chinese and you're listening to this video, you don't have access to FINRA.org necessarily because you live in another country. This applies to US citizens, and they make sure that the securities industry operates fairly and honestly. If you're interested, please go to their website and check them out. They have some useful information. So that concludes Module 3, Section 2, and I will pick up again in Section 3.